Welcome to DoubleLine's second annual Roundtable Prime, moderated by DoubleLine Deputy CEO Jeffrey Sherman. 5 thought leaders in today's financial markets will discuss their take on the economy and their outlook for the financial markets. Roundtable Prime was recorded on January 5th, 2021, and will be divided into 3 segments: global macroeconomy, financial markets, and best ideas. Each segment will be released separately once a week for 3 weeks in January. The roundtable guests, all with decades of experience in the financial markets, are recognized leaders in macroeconomic analysis, market research, and investment management. They bring together a broad array of knowledge across different sectors of the financial markets, including fixed income, credit, equities, real estate, and commodities. All have been sought after for their insights as speakers and as commentators in the financial media. And now, DoubleLine is pleased to introduce the honored guests of Roundtable Prime, our moderator, and our host. Jeffrey Sherman will moderate today's discussions. Mr. Sherman is Deputy Chief Investment Officer of DoubleLine Capital and a portfolio manager of a number of DoubleLine's fixed income and derivatives-based strategies. He also hosts the Sherman Show podcast series, which has featured many of today's distinguished guests and was named one of the 10 must-listen podcasts by Business Insider in 2020. Ed Hyman is chairman of Evercore ISI, where he heads the economic research team. For the past 45 years, Ed has been ranked by Institutional Investor Poll of Investors for economics and ranked number 1 for 35 years. Ed Hyman is highly regarded for his origination of econometric modeling and real-time surveys to gain insight into the unfolding business and market cycles. James Bianco is president and macro strategist at Bianco Research, which he established with the aim of originating insights unencumbered by traditional Wall Street research. His commentaries address such diverse subjects as monetary policy, the intersection of markets and politics, the role of government in the economy, fund flows, and positioning in financial markets. Jeffrey Gundlach, host of Roundtable Prime, is founder and CEO of DoubleLine Capital, an investment manager with investment strategies in fixed income, equities, real estate, and commodities. In 2012, 2015, and 2016, he was named to Bloomberg Magazine's 50 Most Influential. In 2017, he was inducted into the FIAZI Fixed Income Hall of Fame. Danielle DiMartino Booth. Danielle DiMartino Booth is CEO and Chief Strategist for Quill Intelligence, a research and analytics firm whose commentary appears in the Daily Feather and the Weekly Quill. Prior to Quill, she served throughout the credit crisis as advisor to Richard Fisher, president of the Federal Reserve Bank of Dallas. She is author of Fed Up, an insider's take on why the Fed is bad for America. David Rosenberg is president and chief economist and strategist of Rosenberg Research Associates, an economic consulting firm providing analysis and insights to investors. Prior to founding his firm, he was chief economist and strategist at Gluskin Sheff & Associates. From 2002 to 2009, he held those positions at Merrill Lynch in New York, where he was consistently ranked in the Institutional Investor All-Star Analyst rankings. Jeffrey Sherman, Deputy Chief Investment Officer of DoubleLine, will now open the first of 3 segments of Roundtable Prime: Global Macroeconomy, State of Play and Outlook.
Okay, so let me pick up on something that Ed mentioned too about the wealth effect, and not just asset prices on the stock market, but also the housing market. And so we look back to what the Fed was talking about. Prior to the pandemic, they were talking about more equality and sharing across, the different income cohorts. But here we talk about wealth effects, and these are for asset owners. Even home prices are people who are owners, not renters. And so aren't we creating a more polarized kind of version of society through this creation of wealth effects? And so how are we trying to tackle that going forward? And maybe Danielle or Jim, you guys can talk about that, focusing on the Fed. And should this be part of their mandate? Again, they already have a dual mandate that's difficult to accomplish. Aren't we just trying to look to the Fed to answer all of our problems?
I'll be quick, and then I'll let Jim jump in. Right now, cash out refinancing is running at $100 billion quarterly run rate. People who do own assets, and we're talking about half of Americans, as opposed to it being so concentrated in the top 1 to 10% when you're talking about equity ownership. So right now, the Fed is trying to have policy reach the interest rate sensitive sectors, which Powell mentioned in his last press conference. Well, they're doing a heck of a job of that, but we have to bear in mind that the last time they did this, A, it didn't end well, and B, you ended up coming out at the other end with things like private equity investors getting into single family homes. And now you see why this rental eviction moratorium almost needs to be indefinite in length, because housing has become so untenably affordable for the average American, for the worker bee, for anybody who has to commute, that the Fed has backed itself into a corner. And yet the only thing policy continues to do is to widen the inequality gap. There was a Bloomberg columnist out a few days ago that said that the Fed had done nothing to create the inequality divide. And I got on Twitter and I corrected him and I said, no, the Fed can't do anything to reduce inequality. They can do everything to increase it, but they have no tools in order to reduce it, nor can they address climate change, which is a whole nother story. So I'm going to stop there and let Jim jump in.
Yeah, I just on your last part, at least they have some kind of an impact on the wealth effect where they have none on climate change whatsoever right now. But the bigger problem here is the Fed has defined the economy as asset wealth. You saw that back in March. When did the Fed finally start to react, and what was the reaction? It was to a falling stock market, and it was to aggressively intervening when the stock market was falling. And they pretty much defined the success of their programs as getting asset markets to go back up. And their argument was falling asset prices are going to depress the economy and increase unemployment, and rising asset prices are going to undo that. They're going to lower unemployment and they're going to pick up economic activity. Now, I would argue that that has demonstrably not been the case throughout the rest of 2020, but that's the way that the Fed has been operating right now, is that they've got an eye on asset prices, and that is kind of their North Star as to where they're going. Now, I know that they've tweaked their mandate and they're going to allow inflation to run a little bit hot in order to get the unemployment rate down. Yesterday, Charlie Evans of the Chicago Fed said he could see the average inflation on core PCE going to 2.5% without the Fed moving policy. By the way, 2.5% would be a 28-year high in core inflation. It hasn't been above that level since 1993, basically, right now. The problem with all of this is what you saw in the fourth quarter of 2018. Jay Powell comes out on December 19th, 2018 and says, we're going to reduce the balance sheet by $60 billion a month. It's going to be an automatic pilot. It's going to be like watching paint dry. During that press conference, the S&P fell 3% while he was explaining that, and it kept going down, and eventually from top to bottom, the correction was 20%. That was December 19th. It's automatic pilot. It's going to be like watching paint dry. January 4th, after Powell got back from the Turks and Caicos, he goes out on a press conference, he gives a speech in Atlanta, the American Economic Association, and he says, we're going to be patient and flexible. In other words, the Fed spent months and months putting together a policy to reduce the balance sheet. The market had an adverse reaction. Within 2 weeks, that policy was in the trash can, and they went with a completely different one. When it comes to inflation, when it comes to the markets, if Charlie Evans says, look, we the Fed will tolerate 2.5% on core inflation without raising policy, it's not up to you. It's up to the markets. If we get 2.5% core inflation, 28-year high, and all of a sudden you see the bond market falling and yields spiking, your policy's right in the trash can and you're going to be forced to raise rates. You go to 2.5% and the bond market's completely fine with it, then you're completely fine with it too. The markets are going to be running these policies, and that's been more and more the case, never more so than the fourth quarter of 2018.
Yeah. So with that, Jeffrey, thinking about the bond market and the reliance on the Fed to provide support, whether it's explicit, implicit, breaking charters, all the multitude of things they did in 2020. Is the Fed really that relevant as you think about the bond market in 2021? I mean, they've laid out the roadmap. They said they're going to keep rates low. That's what all this jawboning, as Danielle called it, is to do, is to keep rates low and make the market not have a visceral reaction. How are you thinking about it? What do you think about the Fed relevance as we go into 2021 here?
Well, unfortunately, the Fed is very relevant. They're relevant to the extent that they choose to be. Like Jim Bianco said, they were on a path and then they completely abandoned it. And there's all kinds of implicit things that are going on. When you talk about the bond market, let's talk about the Treasury bond market for a subset of the bond market. What you have is negative real yields. And I believe that the Fed wants real yields to be negative. I think the Fed wants inflation to be higher than any interest rate anywhere on the Treasury curve. And I think Charlie Evans, the scary thing that he said wasn't so much we're going to let it run to 2.5%. He actually used the phrase, we're in it to win it. Now, that suggests that there is a very firm commitment to higher inflation. I agree with Rosie that we're not, we had years of these policies and we can't get inflation up. But our model at DoubleLine shows that because of the low level of inflation caused by the economic shutdown and so on, we're going to have about a 2.6 inflation rate, we think, come year over year, come May or June of 2021. And Charlie Evans is saying we're going to let inflation go to 2.5%. She's talking about core, but I'm talking about headline, but it's probably not that big of a distinction. He's saying that because I think they know it's going to happen. In fact, the median forecast of economists is that the inflation rate is going above 2.5% at some point during 2021. So when you say is the bond market is the Fed relevant for the bond market, they're relevant when they decide to peg the yields, to do yield curve control, which they've not been shy about admitting. They've talked about yield curve control. When you look at demand for Treasury bonds, there isn't any. There isn't any from traditional, core holders. Foreigners have been selling Treasury bonds for a while now, and it's been accelerating, right? We have individuals not really buying Treasury bonds. We have pension plans where they're almost removing Treasury bonds from the efficient frontier analysis, because if you need a 7% actuarial return, what's a 90 basis point 10-year going to do for you? I mean, even if the yield goes down towards zero, you're going to barely make your actuarial assumption. You might make it for 18 months, but then you're completely dead. So who's been buying the Treasury bonds? The Fed. And so if interest rates do start to go up and the market starts to worry that they're not inclined to buy negative real yields, the Fed will have to buy them. And there's a couple other things that are going on that are interesting, and I don't think it's an accident. One of them is that average hourly earnings, which is a very funky number right now because there's been such a big mix shift with the unemployment affecting different strata of wages differently. But right now, average hourly earnings are running year over year higher than the yield on the bond market, on the Treasury bond market. So in essence, we're slowly reducing the burden of the debt. Since we're piling on so much debt, it's helpful if the interest rate on the debt is lower than the inflation rate. Also, mortgage rates right now are lower, the 30-year commitment rate are lower than wage growth, which is another way of handling the debt. So maybe diabolically, they're already toying around with controlling things so that the burden of 330% debt to GDP, when you add up corporate, household, and government, becomes less painful on the compounding curve. But that would lead to that would require a direct, obvious, in plain sight yield curve control. And the Fed has talked about that. I believe if rates do move higher, and they should, left to their own devices, there should not be a negative yield on the 30-year Treasury bond. If they start to move higher, I think the Fed will act. The $64,000 question is, where's their pain threshold? for when they would start to act and intervene. And nobody knows the answer to that because that discussion hasn't happened. But my guess, and this is just intuition, I don't have any hard analysis because I don't think that you can find any underneath it. My guess is that if the 10-year Treasury pushed up towards 2%, the Fed would start acting. They want negative, and one more thing on negative yields, I'm talking about the Treasury market. Amazingly, the corporate bond index yield is now -2 versus inflation. Corporations can borrow in aggregate at negative real yields. So it's a fairly remarkable situation that we have real yields. I mean, mortgage rates, if the inflation rate goes to 2.5, the present 30-year commitment rate would be lower than the inflation rate. These are all things, that are probably supportive of the economy, but ultimately, I'll go full circle. Ultimately, you really do need wage growth, and that to me is AWOL for the time being, particularly at the middle level. I've been talking about for months now that the disinflation of wages, of earnings, is going to start climbing the economic ladder. At first, it was the baristas that got laid off, and they got their checks so that they, wouldn't go homeless. But I think it's going to go up the curve. And one last thing about the lockdown. I saw an amazing survey. I saw it yesterday. It's stale, unfortunately. I wish it was updated. It was taken in July, I believe. But it showed that over 90% of people want to work from home at least 1 day a week, and 2/3 of people want to work from home 5 days a week. Now that's stale, that's back in July, but that's a really big shock. We're used to dealing with these virtual things, but I just think we don't really know the long-term effects of all of these policies and all these virtual things. And I'll stop by saying I agree with Ed. I don't really know, and I worry what the unintended consequences of all these things we're doing are, because, and back to what Jim Bianco said, there are going to be losers in this game, and they haven't been identified, or I guess the gods haven't chosen who the losers are going to be explicitly yet.
Well, don't ask the Fed to play God, at this point. But Ed, he gave you a great segue, Jeffrey did there. But let's talk about one of the factoids I heard was that, COVID wasn't really a game changer. It was an accelerator, right? It accelerated trends that were underway prior to the pandemic. How do you think about that when thinking about the overall economy and the work you guys are doing, and whether it's analytical or just counting, as you called it? When you think about this acceleration of trends that are underway, and was there really disruption, or was it just acceleration?
But Jeff, I got to go back a little bit, okay? There's a lot of water on the bridge. So going back, Rosa, to your points about inflation, the guy's dead on. I mean, maybe we get inflation, but it's been tough. And I think the strongest point, it's not really the strongest point, but a point he raised is on China. So China growth this year is going to be 8%, and their inflation is essentially 0. They reported this week that the core inflation in Korea is 0.5 year on year. So, Rosie, I think you're dead right on inflation, but you got to be flexible. And if wages start to pick up, then we'll change our view. But here's what I want to come to. In the early 1900s, Alfred Marshall, a famous economist of the time, presented the Marshallian K, which is the inverse of velocity. And so when velocity goes down, the Marshallian K goes up, and he claims that asset prices go up. When there's more money than there is economic activity, it shows up in asset prices. And that's essentially what's been going on. And so I sort of like velocity going down. I will say that from my point of view, the economy since the low point in the spring has come back, a lot faster than I ever anticipated. I mean, I can't believe it. You saw the PMI numbers this week. Maybe they're distorted. We do a survey of Christmas tree sales. They're up 21% this year. Now, Christmas trees are for higher income people. You can't be homeless and have a Christmas tree. But anyway, I think what's going on is very inflationary for asset prices, and like you say, at some point we'll get unintended consequences. But Jeff, as the story goes, we took 7 years of technology and crammed it into 7 months, and we don't really know what the heck is going to come out the other end. This call in itself, the last time we did this call, I flew from Punta Cana, where I am now, as you can see with the palm trees. I flew to LA. It took me like 6 weeks. And now I just get here and having a good time. So it's been an amazing transformation. And I don't think any of us, I'm looking at all of us, every person on this call has been a road warrior. And it's done. So it's a real crucible of activity changes, and I can't tell how long people are going to work from home. Probably a long time, and I don't know how long people are going to not want to go into the office, where you can get the culture carriers and talk around the water cooler. But what a period. So I think I'm going to be here, at least through March, maybe through the middle of the year. And I've been here, so that'll be one whole year.
Think of all the economic production that went into flying you from there to LA, and the hotel, and the people that work on the airplane, and the caterers, and I mean, it's sort of like all that growth, or all of that economic activity has disappeared, and it's shifted so remarkably. But to get to Sherman's question, I am firmly in the camp that this was not a trend changer, but an accelerator. It's just, imagine if this pandemic had shown up 8 years ago. What would business have done?
I don't know.
I mean, it would have just been complete standstill. There's people, I know Elon Musk throws up the theory that we all live in a computer simulation and there is no reality. But you got to hand it, if that's true, to the simulation that they didn't drop this on us 8 years ago, because I can't even imagine what would have happened.
Yeah, no, it's been, I can speak for everybody. It's been seamless. It's been astonishing. But I also say we're so lucky that we have jobs. The ones you mentioned in the related airline, they can't do it virtually.
Right.
You and I can.
And that was
a lot of interesting. I was looking at a chart yesterday that showed business shrinkage by industry, and the industry that's had the least business shrinkage of the 20 or so that they had identified. And there's always problems with these surveys because there's gray areas on where businesses sit. But the industry that had the least drop in output was financial services.
Well, if I could add one thing, while a lot of trends were definitely accelerated, and we've seen time compression, and we've especially seen that in the commercial real estate cycle, I would add that as far as trend changing goes, 1 in 10 employees globally pre-pandemic was employed in tourism and hospitality. And so that is going to be a structural change that we will be contending with for a generation now, I think, given how seamless the technological shift has been for so many of us.
I don't think that people fully comprehend or have deeply contemplated what the, I would say, 15-year, to pick an arbitrary time frame, effect is on mental health and on what is going to develop from the generation now that is in elementary or junior high school and has had something that resembles a trauma, I believe, occur to them. And I think it's going to lead to really significant mental health problems that are, and unfortunately, that I think is a trend changer. I mean, but I think isolation and being stuck at home and child abuse and domestic abuse, people aren't talking about these things, but they've exploded, as have violent crimes of all types are exploding. So underneath the surface of, hey, the unemployment rate's down, below 7, there's a lot of disturbing trends that are happening. As again,
that's Jeffrey. That's why the Fed is pushing so hard, and policymakers are pushing so hard. But I'd say that I think that there's a huge amount of pent-up demand to travel. Peggy Noonan has a great opinion piece this weekend. She says, "I have a dream," and it goes on and on about the dream she has to get back to normal. And she says, "I can't wait to get on a plane and go to Paris just to see if it's still there." That's her words. But I can see where people right now. I'm in a tourist place. The island I am is basically one big tourist destination, and I think in the past couple of weeks it's exploded.
It's interesting because I noticed that we follow the TSA traffic statistics to try to see how things are coming back. And it was pretty surprising that the holiday season this year really was up quite a bit relative to the trend of prior months, which corroborates, Ed, your idea that there's a lot of pent-up demand, because here we have a big spike in COVID cases, and people are supposed to be super careful. And yet people are just saying, whatever, I'm going to see my family for the holidays. And it's clear in the data that happened. So it'll be interesting to see if we get yet another spike because of people's pent-up demand being partially spent with their activity here in the holiday season.
Jeffrey, we've actually already seen it. If you look at the R0 factor at the kind of the post-Thanksgiving peak, there were 25 states that had an R0 factor, so transmittability rates were below 1 in 25 states. That's the best it had been in a very long time. And as of today, we've taken it back down to just 6 states with an R0 that is below 1. So we are seeing the case counts rise and transmittability rise.
And that was just Thanksgiving. I'm talking about the latter part of the year where the travel clearly went higher, and that has yet to had sufficient time to come back and boomerang. So that's still coming.
So we need vaccination.